Hi, folks. My name is Dan Storck. I'm the Mount Vernon District Supervisor, and first and foremost, want to thank everybody for coming this evening. This tonight's discussion is about real estate assessments, and we'll be solely focused on the assessments. And appreciate you and focusing your comments and questions related to your assessments. And the intent of this meeting tonight is to help you and help all of us, if you will, learn about the assessment process, not only globally how it works, but also specifically in neighborhoods and individual homes, how that works. I'm excited that the Department of Tax Administration is here, and I'm going to introduce Jay Doshi in just a moment. Just want to remind folks that last night I had a budget meeting, where we spent the better part of 2.5, almost 3 hours meeting with folks virtually and in person regarding the county executive's proposed FY 2024 budget and the real estate tax rate that he was recommending related to that. So that was the focus last night, and I just would urge everybody, if they have questions, to more than welcome to send them to me. Additionally, if you have comments you want to make, we have budget public hearings that are on April 11th, 12th, and 13th. Again, our annual budget public hearings are 11th, 12th, and 13th. Please feel free to sign up to speak. There's really 3 ways you can present your comments or questions. One, you can send a video link at least a day ahead of time to advise us, your particular views. You just record it with a mobile phone or anything else and just upload that link for the instructions, and that's good. You can call into the meeting if you like and just answer questions, make your comments via telephone. You can appear in person, which is probably still the most common way, and which is at the Fairfax County Government Center. So those are 3 easy ways for you to get involved, and would urge you to please share your comments and views. Tonight I have 2 of my liaisons, 2 of the aides in my office, Peyton Smith and Nick Reinhardt. They're going to be monitoring the team's chat for any questions or comments and try to specifically put things in there. The first thing I want to do, ask Nick or Peyton to do, if they would put in the link for folks to be able to sign up for the budget public hearings on the 11th, 12th, and 13th. But they'll be running the show in the background, and they can at least hopefully address any issues, technical issues that come up. I've heard from many of you, in fact, that's probably an understatement. I would say more this year than I've heard that I can recall about your concerns, questions about the real estate assessments. And most of what I hear isn't necessarily just this year, although this year is a clear focus. It's the increases that have occurred over the last couple years, and obviously frustrated in terms of how and why, and particular thoughts about what other neighbors or you think their houses are selling for, or what they might sell for. But that's really what the intent of the meeting is tonight, is to get to the bottom, if you will, to get to the methodology. And it really is a scientific methodology that our Department of Tax Administration uses to determine what the value is of your property. They're not perfect. I think we all recognize that. So that's really why this interaction is critical, but they can at least show you the methodology process that they use, and then more than happy to speak with you and meet with you individually to walk through your specific situation. They're not going to be able to do the specific situation tonight with you in the meeting, but they can probably at least give a general idea of how they arrived at the information broadly that I think we're all particularly concerned about. As I've said at the budget meeting last night, and I will repeat again tonight, I am committed to lowering the real estate tax rate. I think it's essential that we lower the real estate tax rate. We've just gotten the county executive's budget about 2 weeks ago. I need to spend time going through the budget to look and see what our opportunities and what the possibilities are for doing that. But that is something that I'm actively working on, and I will not support a budget that does not have some reduction in the real estate tax rate, which ultimately would reduce real estate taxes over what the estimated assessment was that you got. The Constitution of Virginia requires Fairfax County and all counties in the state to do a a market-based real estate assessment every year. It has to be related to market value. Jay Doshi and his team are going to walk through that in far more detail, but that is a constitutional requirement that reflect the market. Also, real estates are set, and again, they'll talk about this as well. They're set about based upon mostly the sales of similar homes in your area. The Board of Supervisors does not have anything to do with setting your assessment. We set the rate, but we have nothing to do with setting assessment. That's truly the Department of Tax Administration. That's truly the methodology that they follow, which is to arrive at a number that truly reflects the market value of your home. The tax department team is here tonight again to explain how the assessment process works, to provide an overview of the district and what it looks like, what areas saw some increases, what areas saw some decreases, et cetera, as well as to provide some specific examples of how these neighborhoods came to get the increases that they have, as well as to provide information about how you can handle to appeal the assessment, or to at least have your assessment looked at more carefully. And frankly, ultimately, how to appeal if you're not satisfied with the explanations that you're getting. I guess I would encourage you throughout the program, if you want to put your questions in the chat, please do. I've urged the Department of Tax Administration people to just walk through their whole program before we literally stop at the end and then start answering questions in detail. Obviously, if they see a question and it's part of something that they're doing right then and there, and they can just insert that in as part of the presentation, that's great. But we're going to mostly do the Q&A at the end, and Peyton and Nick will be pulling the questions off the chat. We'll take those and we'll respond. And I'm asking the Department of Tax Administration to respond to them as succinctly and quickly as they can, and then recognize that we can get through more questions. And then obviously, if it's not answered well enough, maybe the next question will answer it, help it get answered better. And then at the end of the meeting, we will provide an opportunity for people to raise their hand. Just push the raise hand button, and we will, in order of the hands being raised, we will enable folks to make any comments or to ask other questions directly instead of putting it in the chat. So we're trying to make this move along as quickly as we can while still addressing questions or concerns you might have. So with that, please welcome our Department of Tax Administration and Jay Doshi, our director. Thanks, Jay.
Thank you, Supervisor Storck. Folks, my name is Jay. Last name is Doshi, D-O-S-H-I. I serve with the Department of Tax Administration as director. And with me are Tom Reed, who is the Director of Real Estate Assessments, and Aruna Pearson, who is the Assistant Director who is in charge of residential assessments. We will, as we go along, we will again reintroduce ourselves. But I wanted us to start with a few things. If we could go to the next slide. Yep. So we'll do the assessments. We'll do the real estate assessment overview. I have a couple of related updates on tax relief. The Board of Supervisors passed fairly recently good changes to the tax relief program. I do happen to have a small piece on vehicle assessments because they also raised a lot of questions last year, as vehicle values have been just totally off the charts. And of course, we'll be glad to take your questions. Next slide, Tom. So I wanted to just pick up from where Supervisor Storck left off. We are responsible for all real estate assessments. We make them independently of anyone else, including the board members. The same goes for personal property taxes, but that is based on a recognized pricing guide. We will come to that in a little bit. The assessments are based on sales data, actual prices paid by our neighbors, generally in the previous 12 months, and Tom can walk you through what some of the exceptions are. Homeowners have a critical role here. Accurate data is the foundation for accurate assessments. So we truly need your help every single year to confirm the property data. We'll walk you through how you can locate it, and that helps everyone in the process. Our intent is to ensure that we have the property data correct, which then results in a good assessment. I would also note that each tax year stands on its own. In other words, we're now looking at tax year 23. You would have received your notice of assessment, and each year stands on its own. All of the sales for 2022 were considered when we were looking at the January 1, 23 assessment. With that, I'm going to turn it over to Tom Reed and ask him to please walk us through a couple of slides about countywide assessments and data, and then walk you right through the assessment process.
Very good. Thank you, Jay. I'm going to leave my camera off while I go through the PowerPoint, if you don't mind. So let's just start off with this slide here. This is just an overall summary of how countywide assessments changed countywide in 2023. Overall, including residential and non-residential, and by the way, non-residential does include multifamily apartments. But the two of those combined in the lower right-hand corner, you'll see the overall increase was plus 6.59% in the base. The key, and by the way, this chart is also broken down between equalization or market change and growth, which would include new construction, subdivisions, land development, things of that nature. And then on the other hand, on the upper left-hand corner, and this is the figure most folks have been interested in, the overall average increase or equalization change in residential for 2023 was plus 6.97%. And just by comparison, we do know just some of the other jurisdictions, Loudoun, the comparable figure was plus 7.79. Arlington and Alexandria, they were a little less, which is expected in the more urban areas downtown. Alexandria is up plus 4.5 and Arlington up plus 4.3. This next slide is, this depicts the share of the assessment pie, if you will, for each magisterial district. Mount Vernon, the lower left-hand side, represents an 8.85% overall pie share, this includes commercial and residential. The 8.85, that's up about 8 basis points from last year when you were at 8.77. In the Commonwealth of Virginia, real estate assessments are legally required to comply with Article 10 of the Virginia Constitution and Section 58.1-3201 of the Virginia Code. Per statute, assessments must reflect 100% of fair market value. In Fairfax County, all real estate is assessed or is reassessed annually as of January 1st of each year. The annual assessment process includes the following tasks each year: verifying physical property data, reviewing of and the accounting for all building permits, and performing routine property inspections. Appraisers verify and analyze thousands of property sales, typically from the 12 months immediately preceding January 1st of each year. Sold properties are compared to properties that did not sell, and then assessments for the entire assessment neighborhood are adjusted accordingly. When analyzing sales, further stratifications may be necessary, such as house style, quality, or age. Appraisers ensure that neighborhood assessments are within industry statistical standards. The annual assessment process culminates with the mailing of 358,000 assessment notices. Industry statistical standards, as prescribed by the International Association of Assessing Officers, include the median ratio of assessment over sale price, the coefficient of dispersion, which indicates the level of uniformity amongst all assessments, and the price-related differential, which shows if high-value properties and low-value properties are assessed at a similar ratio to market value. When verifying and analyzing sales, appraisers consider only market-based arm's-length transactions, or what we refer to as valid sales, Invalid sales are not considered, like those involving foreclosure, bankruptcy, related parties, for example. Appraisers also consider sales from the preceding 12 months, and in some cases may expand their search to 15 to 18 months. Sale prices are compared to current assessments in order to determine the assessment to sale ratios, and then adjustments are made where necessary. At this point, I'd like to introduce Aruna Pearson. Aruna is one of our assistant directors here. She oversees the residential appraisal branch in its entirety. And she's going to go through a couple of neighborhoods that might be of interest and how we approach the assessments in those neighborhoods. Aruna?
Thank you, Tom. Good evening, everyone. As Tom said, my name is Aruna Pearson, and I am responsible for overseeing the residential assessment of all properties countywide. So before we discuss a couple of neighborhood, I just wanted to touch a few items as to what our appraisers do throughout the year. While we are assessing properties as of January 1, and we kicked that off during the last quarter of the year mostly, but starting September. But throughout the year, every day, what we do is our circuit court interface that we have, all the sales that get recorded at the courthouse, we get those sales. So appraisers spend significant amount of time verifying those sales. They look at deeds, they read the deeds, they look at the sales listing, they contact buyers, sellers, the listing agents, and so forth to make sure that we get all the details of the sales to make sure that those are arm's length transactions. And those are the one that determines the fair market values. So as Tom said earlier, and also Supervisor Storck said earlier, that by law, we are mandated to assess these properties at fair market value. So how do we determine the fair market value? We analyze all the sales. We only use the valid sales. When I say valid sales, I mean arm's length sales. Because, you know, if father's selling a property to their son, obviously it's not going to be the fair market value. And sometimes there are foreclosures, all types of those kind of sales they do not truly represent the fair market value. So let's talk about this neighborhood right here. It's showing on the map here. It just depicts the similar properties in that area. And it includes of several smaller subdivisions, which is identified on the right side of this slide. And if you can go to the next slide, Tom. So there are a few bullet points here. So what we do in this neighborhood, there is over 600 single family homes. We looked at the sales that happened during 2022, and we saw that there were 35 arm's length transactions in this neighborhood. So when we looked at these sales and we made sure that we have the right property data of all the sold properties by looking at the Bright MLS sales listing, contacting realtors, looking at the deeds, etc. And then when we compared the 2022 assessments with the sales prices of these sales, those assessments were ranging somewhere between 75% to 91% of the sales prices, with a median, meaning when you're arraying all this sales ratio, assessment to sales price, when you array, the middle number is 82%. So where do we go from here? If we are to assess these properties at 100% of the fair market value, and if they're at the 82% of the fair market value, then we need to increase that assessment. Of course, after making sure that we have the right data on all the sold parcels, all the sold properties. So roughly in this neighborhood, when we increase the assessment about give or take 15%, the assessment is 95% of the fair market value, which is still, if we look at it, it's very conservative in comparison to its 100% fair market value. So what we do is sold property assessment. We assess the non-sold properties very similarly, and our assessment is as accurate as our data. So we also get the data verification by so many other ways appraisers look at the permits, if there is any permit pull for remodeling, for any additions, renovation, demolition. We gather the data from there. There is a contractor's phone number on that. So we reach out to contractors as well to gather the information. What we like to do is hear from you. We want to hear from you. You should review your properties online. And if you see that we have errors in your property description, it helps us if you reach out to us so that we can update our records. And if we have the updated and accurate records, then we will be able to provide the accurate assessments. So here is another neighborhood that I would like to talk about. It's just right around the Sherwood Hall Lane right there. That is depicted in green color. And on the right side, there are names of the subdivisions. So looking at the next slide, Tom. So this also gives here a little overview, very similar to we just talked about. In this neighborhood, this is also a single family neighborhood. There are over 300 homes. And there were 14 sales of these 3 that happened in 2022. Again, appraisers verify these sales. We ensure that we have the right data. We ensure that we have the right condition of the property based on the listing, etc., based on our communication with the realtors, listing agents, selling agents, etc. So now when we compare the assessment of these sold parcels or sold properties against the sales prices of these properties, the median assessment to sales price ratio here is 82%. As we discussed earlier, we are to assess the properties at the 100% of the fair market values. In this neighborhood as well, roughly 15% increase, general increase in the assessment is still at about 95% of the fair market value. So here as well, despite this increase, as you can see, the assessments are still conservative in comparison to the fair market value. So with this, at this time, I would like to turn it back over to Tom again.
Thank you, Aruna. Your assessment may increase for a number of reasons, including recent sales or market activity in your neighborhood, new construction, such as additions, decks, porches, or basement finish, or improvements to the condition of the home, including renovations, remodeling, replacements, or updates. If you disagree with your assessment, we encourage homeowners to visit our website and view your property details and view recent sales in your neighborhood. You can also call or make an appointment to speak with an appraiser. The number to call is 703-222-8234. If you continue to believe that your property is overassessed, then we encourage you to file an online appeal. The deadline for 2023 is April 3rd. When you search for your property on our website and pull up the property details, the first screen you see will look like the one shown on the slide here. Past and current assessments can be viewed by clicking on the Values tab to the left, and recent sales in the neighborhood can be viewed by clicking on the Neighborhood Sales tab to the right, as shown here. The Sales tab will produce a drop-down list, and you can click on each sold property for more details. Appeals should be based on fair market value or sales, the lack of uniformity, or errors in the property description. Homeowners should understand the basis of assessments and should provide facts to support their case. Simply pointing out an increase in your assessment is not enough to justify a reduction. Homeowners can file an appeal online by visiting our website. Appeal forms can also be downloaded, printed, and mailed or emailed. The Department of Taxation will process the application, contact the homeowner to offer a physical inspection, and conduct a thorough review of the homeowner's property assessment. Homeowners should be sure to include their choice of comparable sales. Once we complete our review, a decision letter will be mailed to the homeowner. If you're not satisfied with the results of your administrative appeal and you wish to appeal your assessment further, you may submit an appeal to the Fairfax County Board of Equalization, or BOE, an independent body appointed by the Board of Supervisors. The BOE has the power to increase, decrease, or keep the same assessment upon its review in a formal hearing. An administrative appeal is not a prerequisite to filing a BOE appeal. If you wish to file an appeal with the BOE, the appeal form is available online for viewing and printing. You can download it or call us to have one mailed to you. You can also email your completed BOE appeal to the email address indicated on the form. The deadline to file a BOE appeal is June 1st. A third and final option for those who are unable to receive relief through the administrative and/or BOE appeal processes is to appeal to the Fairfax County Circuit Court. Neither a BOE appeal nor an administrative appeal is a prerequisite to filing an appeal to the Circuit Court. Just a quick note on commercial assessments, or what we often refer to as non-residential assessments, again, which include multifamily. Non-residential assessments consist of commercial, industrial, and multifamily apartment buildings. As you can see on this slide, the share of the overall assessment base allocated to non-residential has shifted somewhat over the last 3 years. Assessments effective January 1 of 2020, or fiscal year 20, that would be fiscal year 21, were pre-pandemic and non-residential at that time held a 27.12% share. Due to the effects of the pandemic and a fast appreciating residential market, the non-residential share has decreased to 23.74% in tax year 2023, or a change of minus 3.38%. We offer a web app, which is available to the public and easily accessible, and it allows you to view neighborhoods and view median assessment levels within those neighborhoods, and also look at sales that occurred in those neighborhoods. And we'd like to give you just a brief demo, if we can, of this web app. And so here we go.
Welcome to the 2023 Residential Neighborhood Parcel Change Sales Viewer. The application can be found in Fairfax County's interactive map gallery. It was created to visually describe the median percent change in assessment value based on equalization for taxable residential neighborhoods in the county. Please read and accept the disclaimers on the initial splash page to use the application. The application comes with a few simple tools. Up here in the Tools menu, you'll find the About icon, where we define key terms, provide contact information, and list the map's tools. Next to that, we have the Layers icon, which allows you to turn layers on and off. And next to that, here we've got the legend. Over here, we've got an option to change your base map. And lastly, we've got some bookmarks to take you directly to the county's magisterial districts. The application also has a few helpful links. Here we have a link to iCare. Next to that, a link to the Department of Tax Administration. And over here, a link to the county's homepage. With the search bar, you can search by address, parcel identification number, or by neighborhood number. Now let's search for this address, 13751 Marsden Court. This is a 2-story townhouse with 1.5 baths that's in good physical condition. As the map pans, I can immediately see the parcel falls into a green area. That is, the neighborhood had a range of median percent change of between 5 to 9.99. By clicking in the area, I get a pop-up window that tells me this is a townhouse neighborhood called Brookley in neighborhood 81404, and it had a median change of 6.23%. Now that we've zoomed in a little, valid 2022 sales are added to the map. Green flags represent the sale of an improved lot, and red flags represent the sale of vacant land. Clicking on the symbol opens up a pop-up window showing you the sales price, the sales date, and a direct link to iCare. You can also obtain general information about the sales visible on the screen by clicking on the chevron here at the bottom. This table contains some information about the home, the sale, and the lot. It's meant to help you look for comparable properties within a neighborhood. Now let's use the sort feature of the table to help search for a property comparable to 13751 Marsden, the 2-story townhouse. And here we see one in neighborhood 84104. It has 1.5 baths and is in good physical condition. At this point, I can either review the information on the table or double-click, open the iCare screen, and get detailed assessment information from here. We hope you find the application useful, and if you have any questions about the data you see in the map or in iCare, please call the Department of Tax Administration at 703-222-8234. Thank you. Welcome to the.
And with that, I'm going to turn it over to Jay Doshi again, who will discuss tax relief and vehicle values.
Thank you, Tom. So the board has taken very decisive action to increase tax relief for residents. The first one deals with surviving spouses of members of the armed forces who died in combat as determined by the U.S. Department of Defense. There are some stipulations. I'm just going to highlight a few of them. That the death of the service member would have occurred in combat, that the property is the principal residence of the surviving spouse, that they hold ownership solely as a tenant for life or in an irrevocable trust, et cetera, et cetera. The exemption is only for the duration of time that the surviving spouse does not remarry. This is, again, the provisions are laid out in state law, and the board simply followed that. The lowest rate that can be provided in such circumstances is a 1 penny tax rate. In this instance, it's not a total exemption, but in this instance, this is a reduction in the tax rate. The board was authorized to go as low as 1 cent, and the board has chosen to do just that. We are one of the first jurisdictions in the Commonwealth to implement this tax relief. The next bullet you see, the board in December of 2021, in a 2-step process, approved major changes to the income and asset limits for tax relief for the low-income, elderly, and disabled individuals. This is generally for individuals, the low-income individuals who are 65 plus, or disabled individuals who are totally and permanently disabled regardless of their age. So on the next slide, Tom, I will go over a few of the provisions. And this is at a high level, so if you have interest in that, we're glad to put you in touch with our tax relief section. The board added a 75% tax relief threshold. Previously, we only had 25, 50, and 100%. Now, individuals with gross income up to $90,000 qualify for tax relief, provided their net worth is $400,000 or less. The net worth excludes the primary residence and generally up to an acre of land. There's some other provisions, but I'm going to keep this at a high level, as I mentioned. The total taxes that are relieved are up to 125% of the mean assessed value in Fairfax County. That amount for this year is a shade under $900,000. So the taxes on up to $900,000 would be relieved with the additional provisions that the board has put into place. It expanded the tax relief program. The board also adopted a new, I would say readopted, because we used to have this in the 1980s, and the board, we got rid of it because there was not as much interest. With more and more seniors wanting to age in place, wanting to be in their homes for as long as they can, the board has elected to add a tax deferral option. In this instance, income up to $100,000 and net assets up to $500,000 qualify for tax deferral. In this instance, an individual, say, who qualifies for 50% tax relief and wishes to defer the remainder of the taxes can also do that. So they have the choice of either going 100% tax deferral or utilizing the remaining balance that may be due, not having to pay any penalties, and deferring the taxes. By state law, the total amount that is deferred cannot exceed 10% of the assessed value. So if my home is worth $500,000, that would be $50,000 total that can be deferred. And at the current tax rate, that would be about 8 years worth of real estate taxes, assuming that I don't qualify for tax relief at all. Okay. And I elect to defer the taxes every single year. Next slide, Tom. We're going to talk a little bit about real estate, about vehicle assessments. I saw a question pop up about vehicle assessments a second ago. We, as you know, given the supply-related disruptions, we all have seen enormous increases in vehicle values. There are people who own 3- and 4-year vehicles who've been able to sell it for more than what they paid for it initially. It has been difficult all the way around. The good news is that we're finally beginning to see a slow resumption to a new normal, if you would. We've just analyzed our vehicle values as of January 1 of 2023. And compared to last January 1, there's a decline of about 9.8% when you put together all of the Fairfax County vehicles. We have close to 1 million vehicles, somewhere over 950,000 vehicles if you look at all of Fairfax County. Last year, the board approved an assessment ratio of 85% to partially offset these unprecedented increases. That 85% was a total tax relief of just a little under $100 million for the residents. And this year, the introduced budget by the county executive assumes flat revenue over FY23. The introduced budget is at a flat rate. The current estimate is that a 90% assessment ratio would keep the average vehicle levy relatively flat. As you know, there are two components. We can certainly analyze the data that we have for purchase for vehicles that were already in Fairfax County, and that's about 75 to 80% of vehicles. The remaining vehicles come in or are moved during the year. So that one depends a little more on market forces, and therefore we're relying heavily on data that we have, but there are also some assumptions made based on information provided by J.D. Power, which provides vehicle data to every single Virginia locality as of now. So we will continue to evaluate the car value trends and make a final recommendation about the assessments and any ratio that the board may wish to approve as part of the FY24 budget in May of this year. There's a beginning of some good news here. Two things. First, the first bullet, until now, folks did not realize, or at least 47% of our residents who either purchased a vehicle or moved into the county registered with DMV, but forgot that they also needed to register separately with Fairfax County, or they faced a penalty. As of January 1, we're able to automatically file these personal property tax returns utilizing new technology, and that eliminates the 10% so long as they have correctly registered within the time frame with DMV. So that's a huge savings for our residents. It's an improvement in service, something that we're very keen on. The next one is more about where prices might go. This is more forecast than it is actual data, but we're beginning to see some of that through wholesale vehicle auctions and sales. J.D. Power, again, the folks who own what used to be the NADA book and the NADA online databases, is now owned by J.D. Power. They expect the vehicle prices to reflect a slow deflation over time, back to a new normal, quote unquote. However, the new normal will be higher than the pre-pandemic levels is what we gather. Part of it is because new vehicle prices have shot up substantially. If any of you have attempted to go purchase a new vehicle, the average ticket price for a new vehicle, total average price, is between $46,000 to $48,000. And it has just been a massive increase. Part of it because of all the new technology that we get in vehicles, but part of it also simply because it's been a supply and demand issue, with many, many dealerships attempting to charge over MSRP. Next slide, please. So we have a couple of slides for you to demonstrate. This came courtesy of J.D. Power, but this kind of lays out in good detail what is going on. So you will see this is for vehicles at average wholesale prices, which is and vehicles that are only 0 to 8 years old. And you will see that the wholesale prices pre-COVID were about $12,700. They went all the way up to $26,600, I'm sorry. And now you see a decline, a modest decline, but still a decline of 12% from the peak. Average used car values, therefore, are still at $23,400, something that was inconceivable pre-pandemic, but here we are. Next slide, please. So we thought you'd be interested in a real-life example. We picked a Toyota Camry midsize car, 2016, and you will see that a car that used to be worth $16,300. If you go if your eyes move all the way to the right, you will see the yellow dot. It's worth $500 more than it was in 2019 at $16,800. This is as of October 22, but that gives you an idea. What should have occurred and what normally would occur is that the normal trajectory is the one with the pink dotted line, where it would have been worth $10,600. So that was the average trajectory. The supply shortages certainly have impacted the pricing. Therefore, those who were at the selling end were quite happy. Those who were trying to buy, much less so. Next slide, please. Here's an example of a Jeep Grand Cherokee for you. In this instance, there is some depreciation, thank goodness, but nowhere near what it would have been. So again, the value in January of 2019 would have been $29,300. Today it is $25,500, a decline of $3,800. But versus what normal would have been, it is still an increase of $6,800. Again, this is as of October of 2022. Next slide, Tom. So this is a chart that kind of shows what J.D. Power believes to be the push and pull in the used car market and the new car market all put together. The anticipation is that by the end of December of 2023, there'll be higher new vehicle incentives. You're beginning to see some lower APR and some small rebates that are now being advertised, a higher new vehicle supply, but the higher interest rates and weaker economic conditions are likely going to impact used car prices and new car prices as well. The expectation is that the used car supply will still continue to be modest, and therefore that will have a slight upward pressure. So these are the different things that are going on and are expected to be going on according to J.D. Power as they're looking at what they expect the market to be. Next slide. So with that, we will be glad to take your questions, and we all have comments, but I'm going to rely on Nick and Peyton to send us the questions, and we'll try to figure out amongst ourselves who is best able to handle it.
Let me start by thanking
Yes,
you, Jay, for your presentation and thanking really the great many wonderful questions that are in the chat. So I mean we've got a great place to start. I see Lori and John and many others have put some really good questions in here, and I'm looking for Nick or Peyton to serve them up to you. And I would say let's just go down from the beginning to current, and then when we get done with those, then we'll open it up for people to raise their hands and be able to speak personally. So let's get started with those and see what we can do.
Yes, sir.
Thank you, Supervisor Storck and Jay and everyone on the budget team. The first question that I saw in the chat, excuse me, was from Lori, and I believe she was asking here, how many houses being sold are renovated and or have additions? What if your home has not been modified in the past 29 years?
Yes, indeed. Thank you for the question. I'm going to ask Aruna Pearson if she can take that, please.
Thank you, Jay. So as I said earlier, we verify all the sales. We look at the remodeling, renovation from the listing, from the permit, and we update the record. When we are comparing the assessments, if there is no renovation, it is assumed that the property is in average condition for its age. And those types of average property get compared with the sales of the average properties, and they're assessed accordingly. And renovated, remodeled properties will be compared to the sales of those types of properties. So there's obvious, if you look at the properties assessments, if you look at online, the remodeled properties would have higher assessments. But as you can recall, previously, all of us said that assessments are as accurate as our data. So sometimes when people remodel their property without pulling a permit, or if it wasn't sold and we have no way of knowing that property was remodeled, then we might have that in average condition. So it is important for us to be made aware of what the accurate status of the property is. We also encourage you to invite us to inspect the property so we have the right data. But in summary, in short, average properties get compared with the average property sales and are assessed accordingly. Next question.
Sure, I'll take the next one. Al asks, I live in a 1950 era house in a planned community that was assessed around $600,000. The original houses, same model, on both sides of me were bought and torn down. Now houses with 4 to 5 times my square footage have been built and sold for almost $2 million. How does the county make a fair market value assessment for my house if there are no comparables remaining?
So I would make
we have
a
a lot
couple.
of those in Mount Vernon District too. A lot of those by right tear downs, and this is a really important question for the community. Thank you.
Sure, thank you. So I would make a couple of points here. So let's just talk about tear downs. So any neighborhood, it goes through phases. It's you know, when the new neighborhood comes online and then it develops, and then as property ages, it goes through gentrification, and when the properties are beyond its economic life, and when land is so scarce, obviously we cannot produce land with the demands. What developers do, they come in, swoop in there and take those dilapidated homes, they buy that and then tear that down. So that sales price that they are paying for those tear down sales, that is actually just the price of the land value. That means land is just so valuable, they are willing to buy that and tear it down and then put a new home and then sell it at a much higher price. So when you have a home, similar home, which you are still living, it's very old, and then your surrounding neighbors have these tear downs. So one thing to keep in mind, that the land with an old home that is still in livable condition, it is still within the use as a residential property from whatever year that it was built, their combined assessment cannot be less than that tear down sales, because even if you look at that property, just the land itself is whatever the sales price is. Let's just say that it's sold for $500,000. So if the land value is $500,000, then the next door lot with an old home on it cannot be assessed less than $500,000. So that's the one part of the answer. Now, as far as finding the comparable, what we will do is we will compare If there are any sales that is not tear down in the neighborhood, that is similar type of older homes, we would compare the assessment. So we will look at both aspects of that. That what would be the value just as a land, as a vacant land, if it was just vacant land, and also how the old homes are selling. So sometimes you may not find the sales right within the neighborhood. If that happens, then what we do is what we draw to our attention towards sister neighborhood to find the similar property sales to determine the assessment of those type of properties. But we cannot disregard the tear down sales as well while we are doing that. Hope that helps.
Yeah, it definitely does. The next question I have here is how are current economic conditions, which will affect the future sales prices, considered in the evaluations?
Okay, so assessments are as of January 1. So in order for us to determine the assessment as of January 1, we look at the sales that happened prior to January 1. So there's a lot of prediction, a lot of forecasts that real estate probably might, tank, or some economists is saying that it's still not going to be tanking, but maybe it will be remaining stagnant and may not be much appreciation, depreciation, whatever the case may be. So anything that happens now, happening right now, and continue to happen till the end of this year, all the way to December 31st, all those sales will be analyzed all over again, and that would be reflected in your 1/1/24 assessments.
Okay, got another question in here. This one seems to be more on the enforcement end. Mr. McKinnon here asking, when it comes to tax enforcement on car property tax, why is it not being enforced on, or is it not being enforced on out-of-state cars?
I think I'm the only one qualified to take that, although the subject matter experts are not with me. No, we get thousands of complaints about out-of-state plates. The reality is that this is an ongoing challenge. We live in a metro area where people are free to move. They may live in DC, they may live in Maryland, but still come to a job here. And in years past, Maryland made it easier to title vehicles. And all of those things have had an influence on the sightings of Maryland plates. With all of that said, we work with the sheriff's office, we work with the police department, and we have over a dozen employees that do nothing but canvass neighborhoods or look at leads and try to make a connection. Legally, we cannot assess someone without having a tie to that individual. It's called situs of a vehicle. So there are legitimate reasons why people, especially during the pandemic, had out-of-state vehicles. You may have had grandma and grandpa helping out while daycares were closed, and they may have lived in another state. They had the right to live here with their children and grandchildren during the pandemic, and they were not required under many circumstances to register vehicles with DMV or with Fairfax County. We also have students that enjoy a separate provision. So if you have a student that goes to GMU or any of our fine institutions, they legitimately are permitted to have out-of-state tags. For those who live here, work here, and where we can demonstrate a connection. The term is normally garaged or parked. If the vehicle is normally garaged or parked in Fairfax County, the expectation is that they register with the DMV, that they pay the Fairfax County taxes, and there is a no plate penalty and a no plate tax that adds up to $250 a year, in addition to normal personal property taxes, if the individual does not get the correct plates. So I wanted to pass that on. If you know of vehicles in your neighborhood, we call it the Target program, TARGET. If you search on our webpage for out-of-state plates or Target, you will see that there's an online form. We welcome any and all reports of out-of-state vehicles that you think are being parked overnight for long periods of time. And we will do our very best. I can't reveal all of the sources of information, but let me just say that we have access to DMV, we have access to Virginia Employment Commission, we have access to credit history reports of individuals. We know where someone, if they claim to be in Florida, but they routinely get an oil change in Fairfax County, in most instances, we can know that. So there are a number of different ways in which we attempt to determine if there's a connection. If there is a connection, we will assess them the personal property taxes. It is, as you can imagine, a time-intensive process. We're glad to embark on that and bring that to closure if the person is truly not a resident, is a resident of Fairfax.
Jay, is that something that people can do anonymously? Is there
Yes,
any?
sir. Yes, absolutely. We'd love to talk to individuals to get a little more data, but if they feel uncomfortable with providing their names, it is no problem whatsoever for them to not provide their name. Yes, sir.
All right, so the next question I have here, is the county able to give tax relief for EVs?
So there is a provision in state law. I think the county for now is doing a number of things to promote EVs. But at this point in time, EVs are taking off on their own. I was asked a question about this. From a policy standpoint, you now have a robust up to $7,500 federal tax credit. So I think the county and Supervisor Storck knows a lot more about this than I ever will, has focused on helping facilitate infrastructure for charging, et cetera, to promote EVs.
Right. Next question. I'm gonna hit a couple real quick. There was a question earlier about will these slides that you presented be provided or posted publicly? So the
Yes.
answer is yes. Okay,
Absolutely.
excellent. And then another
And
question.
when, Jay, you know when that'll be, just so people have an
Yes, sir.
idea?
I emailed them to Nick and Peyton,
Yeah.
and whenever they get a chance right after the meeting, we're happy for them to be posted.
Okay, great. There's another question about the, it's more of a comment about the asset limit for tax relief, saying that it should exclude retirement funds, at least up to some percentage. Could you briefly talk about kind of what is or is not included in that asset limit?
Sure. So assets at this point in time, the way the calculation of the net 400,000 is considered, 401ks and the like are included. So that comment is accurate. And ultimately, it really comes down to a balancing act for the board. The current fiscal impact of the tax relief program just for this piece is estimated to be $55 million this fiscal year, this upcoming fiscal year. And when we add them along with those for veterans and disabled veterans and others who have been killed in the line of duty, I think we have reached a point where we're going to exceed $100 million in fiscal impact. So it's really, these are the difficult choices that board members make every single day. And I'm glad not to be in Supervisor Storck's shoes when these decisions are made.
We have another question from Lori here. I noticed in our neighborhood high sales in the first half of the year and basically no sales in the second half of the year due to market conditions. Is this factored in? What if there are no sales of average houses in your neighborhood?
Tom, would you like to take that, please?
I can take that.
All right,
Oh.
Aruna.
I'll let Aruna
Okay.
take that, please.
Sure. So as I said earlier, what we do is we look at the 12-month sales. If you have any specific information regarding your property, we would love to chat with you one-on-one. I encourage you to talk to our appraisers. But generally speaking, we look at the 12-month sales. And to my knowledge, to best of my knowledge, obviously I can't recall every single neighborhood in Mount Vernon district, that we do have the sales spread out pretty much through the year. It may not be necessarily in December, but it is kind of pretty much spread out through the years. But if you have any specific, particular neighborhood or property in mind, we would love to hear from you individually and directly during our normal business hours from 8 to 4:30. Please call at 703-222-8234 and speak with one of our appraisers.
Aruna, am I correct if I might just ask a follow-up question? Am I correct in assuming that you would not attempt to estimate or prognosticate what might have been, that you're relying on actual sales data and not what could have been?
Yes, that is correct. We rely on the actual sales that occurred, and so long as they are valid arm's length transaction, that's the one determines the fair market value. It's not speculative.
Okay, and if I could, one final follow-up. If that same neighborhood experienced sales, let's say 3% lower in 2023, you will factor that in so long as they're arm's length for the tax year 24 assessments?
That is correct, yes.
Okay. Thank you.
Thank you.
And I believe a version of this question may have been asked before, but I'm seeing it a couple times in here. How is current projected property deflation being accounted for in valuations?
So the question itself kind of says projected. So we rely on the actual sales that happened prior to date of valuation. So any sales activity that happens this year, either now or all the way till the end of the year, all these sales will be analyzed and will be factored into the 2024 property assessments.
All right. Next question, how do you allocate the sales price between land and structure? Are tear down sales listed in your neighborhood on your tax charts?
So the assessments are on the total property value. Our goal is to get our ultimate total property value at the fair market value. Now, the allocation of land to building value may vary from neighborhood to neighborhood, but generally speaking, what we like to do is that land to total ratio that we have in neighborhood, we do not want to change it drastically. So we try to change it no more than certain percent, try to keep it pretty closer, so long as the total value is at the fair market value, because the tax rate is not different on land and on the building. It is on the total assessment.
Another question here, if a kitchen was remodeled 8 years ago, is that factored today as a remodeled home? Why should our home and auto assets exceed inflation rate?
Is this a two-part, real estate and the car? So I would take the real estate part of the question. Am I understanding the question correctly? Is it a two-part question?
It was sent in with 2 messages, so I'd take it that they're 2 separate thoughts.
So yes, for the remodeling, what we do is every year we meet and our cost team meets and they analyze all the sales and factor in by each component, each amenity of the home to see that how many years after the property was remodeled that it is still showing difference in the sales prices. We compare each sales within the neighborhood. So long as market still justifies that, yes, there is a little value remaining of that remodeling, so that renovation will still have the value. So like we said many times before, that we have to reflect what the market does. Market gets determined by the purchaser, sellers and buyers in an open market. And whatever is reflected in market, it is our responsibility to reflect in the assessments.
Okay, next question, from Al again. If a resident moves into Fairfax County from another Virginia jurisdiction, how soon are you notified for personal property tax purposes?
The expectation is that within 30 days of their moving in, that they are changing their address with DMV. That's the responsibility of each individual car owner. If there is a delay in that process, we have the current year as well as 3 prior years to assess with penalties and interest if necessary, if someone chooses not to register their vehicle because of either a difference in tax rates or what have you. If the circumstances warrant and it's appropriate for us to provide relief from that penalty on a one-time basis, we will certainly evaluate that.
Right, we have a comment from Ed. Change in my home price or assessment and actual taxation is unrelated to my personal income. And if I'm not selling my home, the increase in my value of my home does not help me pay my bills today. It only makes it more difficult.
Let me do my best to answer that. This is a conversation that the Board of Supervisors has. I know we have it every year this time, and I know many times during the year. In Virginia, the tax system is a more agrarian form of taxation, at least at the county level. More than 65% of our property tax, I think we're up to about 68%, I think this year, is of the revenue that we need to operate the budget comes from real estate taxes. It's a very regressive form of taxation. We recognize that. It's not based on your income. It's based upon your assets, really what you have. And what you may have had in terms of affordability 20 years ago doesn't mean you have that same level of affordability now. One of the main reasons that we do the tax relief for seniors and folks with disabilities is to try to address some of that. I absolutely understand we do not address all of that. My advocacy, and I'm happy to work with our state delegates and others, would be to have some better trade-off to take what is the most, frankly, progressive form of taxation, which is income taxes, and have the state share their income tax revenue with the county. I'm happy to offset real estate tax to do that. I'm not interested in more money. I'm interested in frankly having that money come into us in a fairer way. The state, we send it about $1 to the state, and we get back in direct services. I want to clarify that direct services about 23 cents. Now, I've had a dialogue with another state representative, and they believe that we get far more than that because there's indirect supports. But even the percentage that I've heard that person repeat is still no more than about 60%. So it means that we send $1 to Richmond, and even if you accept this person's contention, and I've not seen the numbers to be able to prove or disprove that, we're still looking at only getting back about 60% of what we send to Richmond, and that is the major source of dollars for county government and state government. I'm sorry, for state government, excuse me. State government has about a $3 billion surplus this year. I would love for them to pay some of the bills. For example, the education bill. Education-wise, the state pays the county, actually overall throughout the state, based on if an inflation adjustment basis, they're not even contributing as much to education as they did in 2008. So we have challenges. The county government does the best we can. I know it's frustrating for many of you. The real estate, the tax rates that we set are based upon what we have in the way of a budget, what we think we have to have in the way of revenue. We have to balance our budget. We have a couple other sources, which thankfully the state legislature, governor gave us a couple of years ago, which is very, very welcome. And I thank them very much for that. But they're fairly small sources, additional flexibility on real estate taxes, sales taxes, the BPOL tax, what they call business professional occupancy license tax, which is based upon gross revenue. And then we have what we talked about a little bit ago, the personal property tax on vehicles, which most people I know find that also very difficult, and it is also fairly regressive. So I gave a long answer to an ongoing issue and problem that we have, and I would love to see tax reform in Virginia. I'm happy to put my elbows on the table and come up with a system that's fair and more balanced. This is what the county government has to at this point in time to use, and that's why we've improved the tax relief, which again Jay talked about a little bit earlier. We recognize that we have to do more, but we also recognize when we do more, we also have, that takes money out of the overall dollars that we collect, and that means we have to find those dollars somewhere else. So it's a real trade-off that we're constantly doing. Thank you.
Thank you, Supervisor Storck. I'm going to change gears a bit and allow Catherine, who has her hand raised, to unmute and ask her question. Catherine? You're able to unmute.
There we go. Thank you. I want to go back to the asset portion of it and how you determine people with disabilities, primarily military. If I understood what you said, if you have a total assets, not including the home, of 400,000 or less, then you can, if you have a disability, military related, then you're not going to be required to pay property taxes. Is that what I understand?
So if I might, it's this one is that your question is general, but it applies to each situation differently. And what I might recommend is you'll see my email address at the end of the presentation. I'd be very happy to put you in touch with our tax relief folks who do a great job, as do all of our appraisers, and get you the right advice. In general, for total disability, but related, total and full disability, but related to service, there is a chance that someone might qualify. But I'm going to leave it at that in broad terms, only because there's so many nuances to this, and this would not be the forum. And the last thing I would do is to give any of you information that is not 100% accurate.
Well, I guess what I understood you to say, and I'll certainly find your email and contact,
Yes, ma'am.
is that your total assets include whatever you have in your piggy bank plus your investments. Is that what I heard you to say?
No, ma'am. So I think there's a general tax relief program, and there are other provisions that apply to folks who are disabled in the line of duty, etc. Completely different set of programs, different requirements. I was simply focused on the couple of programs that had updates, more recent updates, where the board took action to make things better. For the traditional tax relief program, it applies to someone who's 65 or older, owns a home and up to an acre of land, and has up to $400,000 in net assets, or can have up to $400,000 in net assets, provided they meet the income thresholds as well.
Okay, so who do I talk to?
If you call, I'll give you the general number. It's 703
Yeah,
222
yeah,
8234.
yeah.
And if you would ask to speak to the tax relief staff, they do a great job. I don't recall off the top of my head if Supervisor Storck's town halls for tax relief have already passed, but I know that he has advertised some.
Okay, I'll give a call. Thank you. I appreciate it.
Thank you, ma'am.
All right, thank you for that. Another question here. What if there are no sales of similar houses in your neighborhood for 2022? What data would you use in that case?
So as discussed, we look at the sister neighborhood to find the similar property sales and compare the assessments with those sales. We also look at the somewhat older sales, go to 15-month sales as opposed to just 12 months prior to the date of valuation or 18 months. But the preference is to look at the recent sales. When I say recent, I mean within 12 months prior to the date of valuation. That's what I mean by recent sales. And so we do a radial search and find the similar property sales in nearby area and compare the assessment against those sales prices after the verification, of course.
All right,
Okay.
thank you, Aruna. Next
Sure.
question is, are there options to appeal without having a visual field appraisal? For example, if the number of bedrooms noted is incorrect on the tax profile.
So reducing number of bedroom does not necessarily mean that your house is going to shrink. A lot of empty nesters, when they have kids, they need 3 or 4 bedrooms and kids are gone out of the nest. And then there may be a different type of need to update the homes, make the doors wider, the room bigger. They may knock down the walls and turn those 4 bedrooms into 2 bedrooms to make it easier. That does not mean the house shrunk. That does not mean house got any smaller. So number of bedrooms is for information purposes. It is not per bedroom valuation. A lot of factor is taken into consideration when we assess the property, the type of construction, age of the home, condition of the property, size of the home, footprint of the home, what are the similar homes selling at. So there's so much gets into the determining the valuation. It's not simple that 2-bedroom homes will be valued less than the 4-bedroom. That's not that simple as that.
Great, thank you. I have been told by professional realtors that Fairfax County has overvalued my home this year. You have told us that a deflated cost will be taken into consideration in 2024. Does this mean you are prepared to reduce the valuation for tax purposes in 2024?
So allow me to clarify what I said earlier. What I said is what we recognize what market is doing this year, that's what we will recognize in 2024 valuation. We are only into 2.5 months of sales for this year. We have 9.5 more months of sales to coming in. So if market is, if you say it is deflating, I don't know. I haven't studied that. So I'm not saying one way or the other, but let's say it is true that it is deflating right now as of today. We still have 9.5 more months of sales to analyze, to review, to verify, to determine the market value as of 1/1/24. So if it is for the entire year sales, it is true that yes, sales are showing that pattern, that it is less than what the assessments are. Yes, absolutely, it will be reduced. But if that's not the case, then no.
Right, thanks. Next question from Ed. When appealing a tax assessment, how can I find out how extensive and the cost of houses in the neighborhood that have been remodeled? I can't talk to the contractor, et cetera, as done by the tax assessor.
Could you repeat that question? I want to make sure that I get it right.
Sure. When appealing the tax assessment, how can I find out how extensive and the cost of houses in the neighborhood that have been remodeled? I'm unable to talk to the contractor as done by the tax assessor.
So I would encourage you to look at the property. In the previous one of the slide, Tom had shown how you can go and look at those property assessment, click on the neighborhood sales link, etc. You can, whatever particular property that you have in mind, you can click on that property and then look at the details of that property. You can see what was done, and if you need detailed information, that is public information. So you can call us, and then we will be happy to, our appraisers will be happy to help you so long as you call during the normal business hours. The core hours are 8 to 4:30, Monday through Friday, unless it's a holiday.
Thank you. Question here, do the tax relief programs for seniors and or the disabled merely defer taxes and not forgive them? Please clarify if they are deferred. In my opinion, that is ridiculous.
Okay, this is Jay, and I apologize if I was not clear. If the gross income is up to $90,000 and the net assets are up to $400,000, that is an outright reduction in the tax bill, depending on whether one gets 25%, 50, 75, or 100. In addition to that, the board has provided a deferral option. The deferral option would generally be more attractive to those who do not qualify for the traditional tax relief, but yet wish to defer their taxes and are within those higher income and asset limits that were on that slide. In this case, the limits are $100,000 in income, gross income, and $500,000 in net assets.
Thank you. There's another question in here asking for clarifications on options to appeal without having a visual field appraisal.
Beg your pardon, one more time, please.
I'll just read it. Are there options to appeal without having a visual field appraisal?
So it is in the appellant's best interest that we have the right information about the property. If they feel uncomfortable with someone coming in their home, we also offer the video inspection appointments. We can send a link and they can click on that link on their laptop or on their iPad or smartphone. And then they can walk around their home and then show what's going on, what's happening, any damages, or it is best that we inspect the properties. If anyone's uncomfortable, there are other options to do the inspection, and for the exterior inspection, appraiser can still come out there and walk around the home. So that's what I would like to say, that it is best if you're appealing the assessment, let us inspect the property so we make sure that we get the data right.
All right. There's a question here. I think this one is probably intended for Supervisor Storck. What's going to happen to house prices when the new Pendaw Fire Station and emergency shelter opens?
Well, we actually studied that, and I believe that Department of Tax Administration studied it. So I'm going to flip it to Jay, and there's a number of things that they looked at. So I don't know if you recall, because it's now probably almost 2 years ago, but if you could elucidate or elaborate a little bit, I'd appreciate it.
Yes, sir. Tom, I
Sure.
think you took the lead on that for us, if you would, please.
I did. So we took some sample neighborhoods that were in similar situations and analyzed assessments around those facilities as compared to neighborhoods that weren't affected by the proximity to homeless shelters. And the data just, it really didn't indicate one way or another. It was very flat, if you will. And the other thing is we found that there's so much that goes into increases and decreases in the properties, regardless of where they're located, that it's really hard to extract that kind of a factor, if you will, that, hey, your house is going to go down or up this much because it's in such close proximity to a facility like this. It was difficult to come to any kind of a determination, but we did study it. I know one of the sample neighborhoods was the Embry-Rucker shelter over in Reston, and we were able to focus on a number of neighborhoods around that shelter. And we really didn't find an indication that they were higher or lower, for that matter.
My recollection also is that there was some data or some studies or some information from elsewhere in the country that I know it wasn't Fairfax County, but there was something along those lines too. Do you recall that?
I don't, that might have been, one of the county staff that's, involved in this program of
That's
running
true.
these shelters that did that. I vaguely recall that, but I wasn't part of that. Yeah.
My recollection, and it really wasn't inconsistent with your comments just there, Tom, was that
Yeah. Okay.
it wasn't, I mean, it's just such a difficult thing to assess. But there wasn't evidence, clear evidence, frankly, one way or the other.
Right.
Okay.
Well, on
there's
that
another-
line, let me just, on that line, since that issue was brought in, and it's not been addressed yet. One of the questions in the chat that was asked about affordable housing, I thought, I at least wanted to make sure that it got asked, and Jay or somebody else can address it. It has to do with what is affordable housing and a dollar value. So I think part of the question is, what's affordable housing in Fairfax County, which is, I think, a difficult question to ask, because then you have to ask what's affordable, what's not. But I want to at least put it out there. And then this individual also was asking about what happened in Gum Springs community as prime example. I'm not really sure what they mean by that. I don't know if I have any data in front of me, but I'll at least put those out to you to make sure that those questions got asked. If we need to follow up further, I'm more than happy to work with you to do just that.
Aruna, would you feel comfortable addressing any aspect of affordable housing? I know that our expert is not on this chat. Perhaps we can put you in touch with them if you reach out to any one of the three of us. Would that work?
I can kind of just barely scratch the surface on the
Okay.
affordable housing. As Supervisor Storck said, though, I mean, the definition of affordable is different to each of us. So when I am addressing affordable housing, I am talking about the one that is declared affordable dwelling units by housing department. And then there is some set of rules. And again, I want to give my disclaimer first. I am not the subject matter expert here. So it is based on whatever the declaration is. There is a limit on the sales price. It is controlled sales price. There are some rules and regulation that they cannot sell it for 15 years outside that controlled price. There's also some kind of income limitation that if you are below certain income, then only you're qualified to purchase. So I would encourage those that want to get more information to reach out to housing as opposed to tax administration. Our responsibility is to value those properties according to the regulation, but we don't create that program. We are just the appraisers responsible to assess those property. The best person to give more information to you is housing, Fairfax County Housing Department.
I think part of the question could be, as I'm thinking about it, we have housing developments that are required to set aside a certain number of workforce housing units. They're typically multifamily, so, and I think this maybe can be addressed through that. But so if part of the question is, if the developer is required to set aside a certain number of units for workforce housing, more affordable units, how does that affect their assessment? And I think you all can, I know based on my consumption, I think you can probably respond to that.
So the workforce housing are the rental properties, but then there is the one that's available for purchase as well. Like in a townhome community, that they are supposed to, if there's going to be, let's say 500 home, then there is a covenant and they require that, okay, you have to build certain ADU, affordable dwelling units. I'm calling it ADU as an acronym. And so for those properties, I mean, that is for the ownership, but there is a controlled sales price on that. And that is based on the income. But as for the workforce housing that is being built recently, those are rental apartment style homes. Those are not for purchase. And that again also is based on the income limitation, household income, who's going to be residing, and there is an extensive paperwork to get the approval to rent that property.
So kind of what I was alluding to, and I guess you can just confirm it. Your assessment, your valuation of the non-residential property is based upon the income stream that they generate. And
That's
so if they have certain number of affordable units where they cannot charge market rate for those units, then that will generate less revenue, which
That's
in
correct.
turn would probably.
Less assessment.
Yes, so
It
I
drops.
just,
The value comes down. When you're dealing with restricted rents, it'll affect the value downward.
I just want to make sure that was clear to folks. Thank you.
Thank you.
John McCune, you have your hand raised. Please unmute.
Yeah, good evening. I'm the one that brought up about Gum Springs, and it's a prime example of the McMansions that are being built, and it's forcing the people out. I remember back in 1980 going back there, and it was nothing but dirt roads, and they didn't even have, I don't believe they had sewers back then. But it's pretty much a African American community, and they're being forced out. It's just like with all the trailer parks that are around here. I consider that affordable housing, but when they take over, where do all these people go?
John, that is a question that I wrestle with every single day and multiple times a day. And you pinpointed a critical issue of how do we ensure that folks who live here now can continue to live here. In other words, how I paraphrase it is leave no one behind. And so we've been very sensitive to any of the manufactured home communities that are being sold. One was just sold this past year, and we spent a lot of time working with the owner and others to try to ensure that at least that housing could be preserved. But there are many other areas too. So that is, and I have a major kind of conversation going on right now with the Gum Springs community. They're getting ready to do a survey to look at kind of Gum Springs history, what it was, what it is now, and what it will be, to try to bring into that, if you will, equation, what the community actually wants and how that can be addressed. In like anything else, it's it's a private property state, and you own a piece of property in Gum Springs or anywhere else, and you want to sell it. The county, state can't stop you from doing that sell it to the highest bidder. But there are other things that we only may be able to do to help the community, including historic overlay district or other things that are part of the conversation that we're having with them. But it's a long-term process to try to adjust those things. But I'm deeply committed to trying to do that.
Okay, another thing I have, just while we're on it, with all this developing going on, it's having a great impact on our schools. Fairfax County schools, we're trying to be the best schools, and they're great. I worked for the school system. You're building all this, you're increasing space, but the thing is, they're not increasing the maintenance staff, the custodial, the teachers are getting what they're doing, but the support staff is they're not recognizing the support staff. And without a good support staff, and that goes on with general county, everything, if you can't properly maintain your buildings to protect your investment, you're not going to have a good system. And we're starting to feel the crunch.
I agree, John. It's an important concern. And that's why we have a school board. That's their responsibility to make sure that we do protect those assets. And that's ultimately why they request the budgets that they request of the Board of Supervisors. I don't get to tell them how to spend the money. I get to have a role in deciding how much money they get, along with whatever they get from the state and federal government. But that is an important part of, I agree, important part of keeping our community alive and prospering is our schools look and are maintained well. And obviously the students the results that they're getting are also excellent. So thank you.
But it's also the fact that we have a lot of out of state in Maryland, DC, because that are using our schools, and nothing's being done about that. They try, but it's hard to do. It's hard to enforce. Just like you're saying with the property tax, Mr. Storck, you even sent out an email addressing it. I've called in, reported a car 2 years. I was told by tax administration that, oh, take pictures and all that. It's not my job. We need to enforce it. You go to City of Alexandria, you don't. Why is that not being? The worst thing they did was taking away the county sticker, because that was the way you could, an officer or parking enforcement could go down the street and there's no county sticker, bam, they got it. That's my biggest P right now, is we got all these out of state. That's a lot of money. That's a lot of money that the county is not getting. I even confronted the neighbor and saying, hey, your property tax pays for the road you're driving on that, you know, so we don't get a lot of money from the state. I did learn that from being on a advisory council. Is it correct that we only get 20% from the state and then 80% is generated from the county?
We send $1 to Richmond, and we clearly get back, in terms of direct support, about 23 cents on the dollar. I mentioned earlier that one of the representatives for our area, the state representatives for our area, believes that number is far higher because we're not including indirect supports to, like, students going down to state institutions, colleges, et cetera, Medicaid and some other things that were mentioned. But I think regardless, even taking the number that this person gave, we get at best 60 cents on the dollar back. So it's an ongoing issue. And I agree with you, enforcement of not only the students in our school, but also the personal property tax is crucial to us, at least making sure that we have fairness in our taxation system. Because to me, that's what I think most people want to know mostly, is that, okay, if I'm going to pay this tax, all right, I don't necessarily like it, but I just want to make sure that I'm being treated the same or similar to others. So it's a key part of it. So thank you, Ms. McEwen.
Okay, I agree, because the personal property, nobody likes to pay it, but we have to pay for it, but it's the services. But when you get somebody that doesn't pay it, and this dude basically laughed in my face.
Yep.
So
Thank you.
I mean, it's just it's mind boggling, because I'm not, to be honest, I'm not going to be able to afford to live here much longer. And I think there's a lot of people that feel the same way.
Okay. Others, I see, Peyton, are you the one who's doing it?
Yeah, let's take the next one here. Get the next one here. What do residential taxpayers pay for affordable housing? Is it 1 cent per $100?
Well, there's different pots of money that go into trying to increase the amount of, or try to maintain the amount of affordable housing. Affordable historically means providing housing for folks who make less than about, this is a household make less than about $50,000-$60,000 a year. I mean, there's different numbers, but that's the core. And the county committed to setting aside a penny on the tax rate, a penny and a half on the tax rate to make sure that we put, it represents about $30 to $40 million to particularly support borrowing and loans, et cetera, that can help mostly private companies, not-for-profit companies, develop this housing. That's that commitment. Additionally, during COVID times, we used a fair amount of the money that we got from the federal government to try to increase the amount of, or the number of affordable units. So we're working in that way as well. And then finally, there's no direct county money in it. I was referring to earlier the workforce housing that larger developments have to set aside roughly 10% of their units that would be below market rents for folks who make less than the average median income, which in our area, the average median income is about $130,000 a year. So thank you. We need to probably keep going too. Peyton, we're almost out of time. I want to make sure we get to everybody's questions, comments.
Yeah, so we have about, I think, 3 more questions in the chat, and then we'll let Catherine go ahead and ask her question.
All right, here we got a question. Why can't the auto tax be based on the inflation rate and not the anomalies in the used car market?
I'm glad to take that, Supervisor Storck, if that works for you. In this instance, state law requires us to use a recognized pricing guide in order to value these vehicles. As I mentioned, in all of Virginia, that recognized pricing guide that is used is J.D. Power's valuation systems. We value them at 100% of clean trade-in value. The board has other options, but they're, again, all of them come with challenges. One of our challenges that is more sort of Supervisor Storck's domain than mine is that since fiscal year 2007, if you were here in Virginia back then, Governor Gilmore ran on no car taxes plan. The pledge was to do away with the tangible personal property tax. It didn't quite work out that way. Since 2007, that amount has been capped. And the first $20,000 of a vehicle's value get a personal property tax relief. It started at 70%. Unfortunately, in Fairfax County, we're down to 49.5% for last year. We'll see where this one ends up. Most other jurisdictions are even below that amount, that percentage. So the board has other options, but the board does not have the ability to limit, or we, quite frankly, since we're the folks assessing the property, we don't have the ability to say we're going to limit this to inflation plus last year's value.
And just quickly on that, your point, Jay, on the car tax. Again, the state has a $3 billion surplus this year. We would all love to see the state to frankly do what it had done or promised a couple of decades ago, which is to eliminate the personal property tax, because the way that they handled that is that the county, we still got our money. We just came from the state instead of coming from local residents, which we thought was we're more than happy to do that. So we would love to see the state increase the amount of their subsidy back to us, or the money back to us, and frankly, fully pay for the promised car tax relief. Personal property taxes, we all know, is one of those things that we hear a lot about, and it's one of those things that's more difficult to enforce. So contact your state representatives and ask them about it. Next, let's keep going,
Right.
Please.
Yep. Henry asks in the chat, as part of your presentation, the Virginia Constitution was shown as the mandated source, mandating that assessments be based on market values. Is there a similar part of the Virginia Constitution about personal property taxes? If not, can't the county decide to freeze those values during horrible years such as the pandemic, when they are clearly overvalued due to the crisis? Especially when there is a slower devaluation. I can't believe from your example that a car purchased in 2016 is worth more in 2023 than its purchase price.
I think we addressed that with the previous question of being able to cap this. The car market has been unusual, to say the least, but the recognized pricing guide allows us to avoid swings on both sides, meaning in the end, it's a marketplace that determines purchase and sale prices of vehicles. But we also ensure when you buy a new vehicle, there's some who are paying $5,000, $7,000, $10,000 over MSRP because the dealers are able to charge that. We do not charge you at that amount. The tax that is levied is again based on the recognized pricing guide. In this case, it works to the resident's advantage.
Okay. All right, and we're going to go ahead
for the
and
board of
call on.
supervisors, and for the board of supervisors, basically the question is, where are you going to get the money to fund the budget? And you can take it out of real estate, take it out of personal property, business professional occupancy. We now have the ability to do that with sales tax. So it's really more, and those have been the tools that we've had, and frankly, what people are are used to at this point. I would love to have that be income tax versus personal property tax or other options, but those aren't options that we have in front of us at this point in time. Thank you.
And if Catherine, I know you spoke earlier, is your hand raised again for another question?
Yes, because I heard some information. The county staff continues to want to change the zoning ordinances. So in single-family neighborhoods, such as the one I live in, which is getting lots of infill, they keep nudging along to try to put in duplexes and fourplexes and sixplexes. If they are successful and do that, which hopefully Dan will not support, what does that do to the assessed value of single family homes, whether it's like mine, a house that's about 1,900 square feet, built in the 60s and updated, and the McMansions that are in my neighborhood. And now all of a sudden you've got an apartment building next to you. What is going to happen with that?
So I'll take that question. Zoning will do what zoning will do. So for the rezoned property, we will value that property per the new zoning. But as far as the situation that you are describing, what will happen to your property assessments? Your property assessment will be based on the zoning of your property, will be compared with the similarly zoned and similar type of property to determine the assessments for your property.
Well, thank you for that. However, just FYI, I spent 20 years in the real estate world, and houses that are next to apartments do not sell well. So I think this is going to go around in a circle where you're not helping the county get good tax value because the properties are not going to sell very well in the future. Just a point to make to the politicians. Thank you.
Thank you, Catherine. We have two more questions here in the chat, and then we're going to cap the meeting. Beryl asks, what are the supervisors doing to obtain a more equitable tax distribution from the state for FFC?
Well, there's a number of things we've done in our legislative package. We've always had in our legislative package the hope, wish, advocacy to have more options for raising money for within the county, and obviously offsetting that with other, moving in our eyes. And if you ask individual board supervisor members, they will tell you explicitly the number one thing they would like to do is to either reduce the personal property tax or eliminate it, or reduce the real estate tax, because again, we all perceive and believe that those are not the fairest ways to raise money. And particularly when you think about schools, is income tax may be a more appropriate way to fund your schools. And since schools represent at least 53 or 54% of all our expenditures in the county, it's the major source of our budget. So other ways of doing that are helpful. So that is, I think, the number one thing that we all would echo. And I know one representative, state representative, introduced to give counties access to income taxes, get some percentage that goes to the state now, and there'd be some trade-offs to that, which again I support, but it's so far not gone anywhere to my knowledge in the state legislature. There's a lot of people who like it the way it is because at this point Fairfax County, frankly, I should say Northern Virginia, highly subsidizes the rest of the state and the rest of the state's budget. So it's a political thing, to be honest. It's just, can we get enough? I mean, it's not a Republican thing. It's not a Democratic thing. It's a, how do we change the tax system so it's a fairer one across the board?
Thank you, Supervisor Storck. One last question here. Where do we stand on pension liability accounts, and are you concerned about the underfunding? Fairfax County put in an extra $25 million. Is that enough given the bear market? Where are the Board of Supervisors on this? Thanks.
Yeah, that's a budget question, and definitely, I know it was asked generally last night and was answered generally last night by county staff. as somebody who's been involved with looking at this for years, not only with the schools as well as the county, the numbers, the percentages do go up and down. I spent a lot of time, I have a finance background, undergraduate degree and graduate degree in management, and took a lot of finance classes. So these are issues I understand and advocate that we get as close to 90 in the 90 percentiles as we can, because that's when you get there, that's when you know you're pretty much fully funded. So we have some work to do on that. The market lately has not been helpful. We're looking for, frankly, a certain percentage. I think it's now 7% or 7.25% revenue, or I'm sorry, income growth each year. If we don't meet that, which is what happened last year, then we're going to look to kick in additional money. We've had some great years too, so it isn't up again, down again. We have one of our funds, it's essentially fully funded, it's in the 90th percentile, but we have two others that are in the 70s and 80s. So it's not in a dangerous area, but it's one that I would like to at least see that we're in the 80 percentiles and continue working for the 90s. And the board has put together a plan to get us there. And that's the plan, that's why that money was contributed this past year, is that we've made it a commitment to be there. I think it's a 10-year commitment. I don't have it in front of me to tell you exactly, but I believe it's a 10-year commitment that we've made to get the funding for those retirement plans at that level. Thank you. You guys all set? Is anybody else, any other questions?
That was the last
That
question.
was the last one.
And yeah, thank you, Supervisor Storck. Thank you, Jay, Tom, Aruna, and thank you, Tom, for sharing everyone's contacts. Appreciate that.
I really appreciate Jay and your team. They're awesome folks, as you can tell, I think, from what you heard today. And if you have any questions, they will be happy to answer them. And you're always welcome to contact my office. You heard Nick and Peyton tonight. They know a lot about these issues, but I have a number of other people in the office as well that can guide you to the right place. We're here to serve you, absolutely. That's why we put this on tonight. I asked that this be done tonight because I wanted to make sure that we answer as many questions as we can. I know nobody likes getting assessments the way that we've gotten the last few years. The only thing I can say that's positive about that is that it does mean your house is going up in value, which means that your asset that you have, one of the most important ones we all have, is going up. And I think we're very fortunate to live in an area that has that kind of demand. People want to move here. They find it vigorous and vibrant and kind of area that they want to raise their kids. And we should all be very proud that we've helped to create that, because it is truly all of us who've helped to create that. So thank you all very much for taking the time tonight, and let us know if we can do anything more for you. Appreciate it.
Thank you.
Thank you all. And one last note, meeting is being recorded. It will be posted on our website and within the next few days. So look out for that, and thank you all again.